Hello, everyone, and welcome to another special episode of the TradFi to DeFi podcast. Today's episode is going to be a little bit more visual in nature. John is going to be giving us a tutorial on bribe mechanisms within DeFi. So, John, I guess you're going to bribe me today. Is that
Yeah, I'm
right?
going to bribe you, right? Yeah, I just wanted to. This is kind of something that's out there. It's people may be picking up on it in their crypto Twitter or something like that, and trying to understand or not understand or haven't done the research or what that might be. But since it's something that I do, I just kind of wanted to share how I learned, kind of go through the process as opposed to being technical and step by step showing you how it works. I'm just going to kind of show you how I got involved in it, and
Awesome.
hopefully that will make more sense, and it's probably easier for me to keep track. So really, the first thing that everybody should be familiar with, maybe just the name, maybe you've never used it, and that's Curve, which is an AMM, but it's an AMM not like any other AMM. This is an AMM that basically only uses stable coins. And it's like, okay, so that's a big deal. But they've been doing this since DeFi summer. So they've been on the cutting edge of this. And being stablecoin liquidity pools that facilitates these AMMs, one of the things when you first start in DeFi and you talk about liquidity pools and putting your money into a liquidity pool to earn some yield is you have to watch out for impermanent loss. Well, the great thing about Curve being stable coins, they're all pegged to a dollar, so there's virtually no impermanent loss, right? They're both a dollar, so it's the same value in the pair. So that's important to know because with Curve, what you can do is say you're in a pair. I think I have DAI and USDC on here. In a normal liquidity pool, like if you go to Uniswap and you want to LP a DAI USDC liquidity pool, well, you have to put equal amounts of DAI and equal amounts of USDC in that liquidity pool in order to start earning the transaction fees that come from that liquidity pool, depending on the size of your investment, so on and so forth. The cool thing about Curve is you want to get in the DAI USDC pool and you just have DAI, just put that in there. And that's why it's an AMM, because basically you're putting in your DAI and, well, you immediately pull it out as USDC. So it is an AMM. But it uses its own liquidity pool, which is all stable coins, which is no impermanent loss. And Curve right now, I think their TVL is about $20 billion. It's the deepest liquidity in DeFi for all stable coins. So it's kind of the kingmaker when it comes to stablecoin AMMs and swapping. And you look at this interface, and when I first saw it, I'm like, really? Was this out of the 1980s, or maybe even if you're lucky, the 1990s?
Yeah, we went back in time, it looks like, with this
Yeah,
user
and I
face.
was like, I'm not too sure about this. And to be perfectly honest, Curve, because it is stablecoin pairs, um, the rates aren't very high on those because they're stable coins, obviously, but Curve is what all the other AMMs use for their liquidity. They swap in and out, and they use Curve for their liquidity. So having $20 billion in TVL, and I don't know what their daily volume is, but it's generating a massive amount of fees, which is where it gets its value from, and that's why Curve is is an interesting investment. If you just hold the token, you don't even have to use the AMM. You just want to hold the token. That's great. So that kind of explains Curve and why it's important in DeFi, and it is a main protocol of liquidity for stablecoins. So it's not going anywhere. It is where everybody goes if you want liquidity for your stablecoin, like UST, which is obviously the big thing in the news now, and it's just blowing up everywhere. They got to use Curve if they're going to be on Ethereum, and and tons of other these algo stable coins. They all come to Curve to get their liquidity. So one of the things, the mechanisms that Curve had very early on, which is now in vogue, it's what is known as voting-enabled governance tokens, which basically allows you to vote on governance proposals for that protocol. And so, well, depending on what the protocol is, you may be interested in voting. You might not be interested in voting. It'd be like, I don't really care what they're doing over here. And, there's many scenarios. But what Curve allows you to do, all of these liquidity pools that they have, they use their Curve token as incentive and incentivizes those liquidity pools. So, and they're called gauges. And so they have a set amount of emissions that Curve does monthly. It's set on a curve going into time. And so it's the available amount of emissions that they use as incentives and gauges for these pools. And so what those gauges do is, if you're vote enabled, if you have locked up your Curve tokens, it entitles you to a boosted return, which can be 1.75, 2.5 of whatever the base APY is. So it's a way of boosting your returns. And that's very popular now. I actually in the Discord, in the meme section, I put a meme in there about it's that infomercial where there's this big huge tank of water and somebody punches a hole in it, and then the guy has this fantastic glue and sticks it over there, and it stops the water from coming out. It's basically the devs and basically the sell pressure on these tokens, because in DeFi, people give away their tokens to incentivize them to use the protocol. But unfortunately, all that does is the people earn the incentives, they dump them back out on the market, and it drops the value of the token. And that's just a problem. And then the main reaction that people or this meme is the devs, it's like, oh, we'll just stick staking in there, because basically that locks up the token. It stops people from selling it, But Curve's been doing this from the very beginning. And, and also when we talk about in January, and there's a whole drama with Andre, but his whole solidly protocol and attempt to use this kind of VE mechanism on Phantom, but Curve has been using this all along. So people are really discovering what has been unique about Curve all along. And they're like, oh, wow, we can actually use that for our protocol. So
what's old is new. That's a common theme.
Yes.
Sometimes there'll be something that's in vogue that was already implemented a while ago.
Right. And I look at all these, and I look at these because this is something I'm interested in. I'm like, okay, here's the staking mechanism that this one protocol, I'm thinking about putting some money in. And, basically what I do if I've had some money earmarked for, additional speculative investments, and it's like, I just kind of shake my head and I'm like, I'm just going to go ahead and put it with the OG, They had it right, the first time. And obviously with $20 billion of TVL, it actually worked. Curve
is about as blue chip as you get in DeFi.
Yeah, I mean, it's right there with Uniswap, and Compound, and what's kind of funny and interesting, we've been doing this, our community for I think we're coming up on an anniversary. I don't know. You'll have to decide what that.
Yeah, we'll have to check the date.
The official day is. But a lot of the DeFi got kicked off in DeFi summer, and there were the OG protocols that there were Yearn and Curve and Uniswap and Compound and Balancer, and they really all got the ball rolling. And then we had this second wave, this DeFi 2.0 with the the Ohm forks and a lot of other things that we covered previously in an article, actually.
Yeah, protocol owned liquidity.
Right, and protocol all owned liquidity, and it's funny that these mistakes people, well, they're not mistakes, they're innovations, and they're trying something new, which is the cool thing about the space to begin with. People can be innovative. Sometimes it works, sometimes it doesn't. But to see some of these second wave protocols then reverting back and using the same stuff that the OGs originally used, it's validation that what they did originally was right, you know. So I mean that's just an observation of mine, and people may disagree about that, but that's the way I see it. So how do we get to?
It's like the
What's that?
real quick on that. It's like the Lindy effect, which is that the longer something has been around, the more likely it is to continue to be around.
Right.
And these types of incentive mechanism, these types of structures are tried and true. And there's a reason that, like you were saying, all liquidity goes through Curve in many of the apps that you know and use. You may not even know
Right.
it, but it's flowing through Curve.
Right. You know, and so early on when I started to do yield farming and looking at trying to actually generate an income from my DeFi investments as opposed to just token go up, you know, which is fine too. But I just wanted to make some income off of it and generate real money, or at least real crypto. So, you know, that's why I first looked into this, and it's like they have an enormous amount of fees they generate every day, you know, and there's a lot of protocols that can't really say that. But anyway, again, that's a little bit of sidebar. So the next innovation after Curve is, and let me go ahead and change my screen here really quick, because you know I'm trying to get all this stuff. Let's see, there's another tab. It is another protocol called Convex, which basically is built on top of. You see that? Are we up? Okay.
Yep, we are good.
Cool. Convex kind of took it another step, and actually some of the devs from Curve helped them design this. And basically this is kind of the next step, because if you think of the next step from liquidity pools, it's taking your LP tokens and farming them. So Convex is basically all of those LP tokens you get when you deposit money into a Curve AMM. This is where you go to farm them, you know, is in the Convex. And so basically they're working with Curve to provide an additional amount of, I mean, they're actually incenting people, and it's kind of, there's a cart before the horse on this one. What Convex saw is that these vote-enabled Curve tokens could decide who basically, how much money is, or how many Curve tokens are awarded to what liquidity pool, right? The gauge that I was talking about. Well, Convex decided and gamified and strategized that says, our goal is to own as much Curve locked tokens as possible and basically control the gauge. That's why they're called the Kingmaker, because I think we'll get to another tab that shows the stats and we can go over there. But they control 55% of all Curve tokens that are locked in that protocol. That's billions of dollars. And so basically, whoever they want to award this gauge to, they can.
And that's an important point on governance to understand.
Yes.
Is that, you know, we often think of a governance token as like a useless token.
Right.
Sometimes I know early on, some people are like, well, what is a governance token? Like the Uniswap token, it's just a governance token. Why is it so valuable? But this ability, especially in this context, to control 55% of the liquidity that's on a platform is tremendously powerful. It's essentially a form of political power expressed over a financial application, because it's a voting mechanism that can be much like a hostile takeover of a corporation. You can buy up public shares of a company, much like maybe Elon Musk has been talking about for Twitter, to gain control over an asset like a protocol which generates fee revenues.
Right.
And so this is a tremendous power dynamic that Convex has.
Right. And so Convex, and I'll just show you the current. If you take your Curve tokens and convert them to one of the things I didn't cover on Curve, you can lock them up to 4 years, and that will give you the highest amount of boost on whatever liquidity pool you're in. But those are locked in there. That's a time lock. You can't use that as liquidity, or you can't use it as collateral anyplace else other than you can take. That's the VE curve. You can with your LP tokens, obviously. But it's locked away, and there's nothing you can do. You just collect the money and the fees from Curve, and just go on your merry way. Hopefully, the reason why you locked it for such a long period is you actually have pools that you have money in that you're actually getting boosted returns on. If you do that and you don't, it's. But with Bribes, now those protocols say. I'll use Frax because that's my favorite one. So Frax has a liquidity pool of Frax and say USDC on Curve. Well, Frax is one of these protocol-owned liquidity stablecoins that if they get a percentage of those Curve tokens, it goes to everybody in that pool. But they own the pool, so they get all of them. So basically what they do is it's a bribe. All you people who vote I think it's every 2 weeks, we're going to set aside $1 million, $2 million, $10 million, how much ever it is, and says those people that vote the gauge for us will get an equal share of the pot of money, the bribe that we get. So if you just have, and this is a case where you would have the token, you don't even have anything in a liquidity pool. You're just collecting bribes, and it's.
And so by collecting the bribe, you have to vote the way that they're telling you they want you to vote.
You just say, because you have a choice, you can allocate your votes and break it up between 10 gauges if you want to, or you can put 100% in one, which is what Frax wants you to do. It's like put 100% on us, and there's a snapshot of the vote, and we'll see how many people voted, how many of their tokens for this, and we will split the pie up, and whatever that piece is, it's yours. And you're like, well, I don't know. I think some people find that to be, I don't know. It's not very democratic, but actually it's ultimately very democratic.
It is ultimately, yeah. There's a lot of different ways to slice it, but it kind of reminds me of the liquidity incentives where you're rewarded in the native token for it's the traditional liquidity mining mechanism. However, it's more like governance mining,
right?
Incentivized liquidity, right? You're basically saying
because what they did, and this is why this whole bribe thing took off. Because say if we go back to last August, and I think this was the first video I did was on the Avalanche, rush that they did, and what they did is they went to Curve and said, okay, we have these liquidity pools. We want you to be on the Avalanche platform. So, port your protocol over and accessible to Avalanche, and we have some liquidity pools that we want to start up because being a new protocol, they needed liquidity. So they just took tremendous, I don't know how many hundreds of millions of dollars that they spent to, okay, so if you are in this liquidity pool on Curve, on top of the Curve rewards, we're going to pay you 20% yield in AVAX tokens. Well, that's fine until the money runs out, right? And it's a short-term thing, and when that goes away, the liquidity goes away, and you're back to square one, right? The incentives are gone. Nobody wants to participate. They take their money out and go someplace else. Typical yield farming or whatever it might be.
We call them liquidity locusts. They come in and suck up all the liquidity, and then they move on to the next liquidity.
Right. And so what protocols finally figured out, and Frax was one of them, and there's many other ones. I pick them because they're my favorite. But they go, we can bribe people with their own token in that liquidity pool, or or pay them an incentive, or we can bribe them to vote to give us. And they found out it was tremendously more efficient just to bribe people. They got way more bang for their buck. Their money went a lot further. It wasn't until the program was over in 3 months and the liquidity dried up and everybody went someplace else. I vote every 2 weeks, and we'll get into how that actually happens. But, I'm not going anywhere as long as these bribes are coming at me. I'm not taking my money out.
I think you're very much like most people who are involved in this. So talk us through, if somebody's listening to this and they're like, okay, I get this idea of bribes. I want to get some exposure to these tokens that let me earn just by showing up to work every 2 weeks to vote a certain way, right? So show us, Don. What's the catch? Where do we start?
Yeah.
What's the first?
Well, there's Curve, and I'm not a vote-enabled Curve holder. I have not locked away my tokens with them. I use the Convex platform, which basically you swap your Curve for CRV CVX. It's a token that is basically 1-to-1. And what this does is for Convex, they get the Curve token. They immediately go to Curve and lock it up. So that's how they got 55% of the votes, because people went over here and said, well, it's earning 41% right now. It's I guess I can't do that. Anyway, it's earning 41%. When I started doing Convex probably almost a year, I guess it'll be a year ago in May. It started out at 70%. Now, what that reward is made up of are actually Curve tokens, CVX tokens, and probably 10 to 15% of that return is in a Curve 3 pool, which is basically DAI, USDC, and USDT. So it's all stable. You're actually getting paid a stable coin return. There's no problem of whether Curve token might go down, CVX token might go down. So is that really a 41% return? Well, part of that is in stable coins, which is really a great thing. So I just started first by investing that way. I thought 70% return was great, and I didn't really pay much attention to it. It's just, as you can see, your total claimable there. It just goes up like clockwork, and it's just, you just watch it. It's almost gamified, and everything's great. And then you can claim them from time to time if you want to. You can let them build up. There's a number of things you can do with those. But what happened is that Convex, after, I think it was, when was this? It was probably last fall. They go, why don't we do exactly what Curve did? And you take your CVX tokens, their native token, and lock it up. And we'll give you the ability to vote on gauges of our farms. So it's kind of that next level, Curve was incentivizing liquidity pools and gauging that. Well, all Convex is, which is basically taking those liquidity tokens and basically doing the same thing. If you vote for this liquidity pool token, and we'll boost your return. It's basically copying the same thing that Curve did, and the bribes are the same. It's a mechanism the same. You vote for this guy, you're going to get, whatever they're bribing, and what does that guy get? They get boosted returns, so it's kind of the next iteration. And I was really great with that. I'm like, that's kind of cool, but I didn't know who to vote for. And then I didn't really understand the mechanisms really well. And it's like, cause it's kind of hard to gauge. Well, they're offering, voter apathy is tough.
Yeah. People just they don't know where to pick. I'm in so many different DAOs that I'm just like, I don't even really care sometimes,
Right, but you're getting paid to vote, so you have to pick something, right?
And then, exactly. So then when you create that incentive, especially like with things being on chain and snapshots being taken, sometimes you never know what type of activity you're doing could be rewarded. But now with bribes, you know exactly what type of behavior to be incentivized for.
Right. So and then the only problem is that it creates a problem because this is on the Ethereum blockchain. Gas is expensive. And although this there's no gas for changing your vote, but still you're going. You got, and I'll show you in a minute. So there is another protocol, that's chaining together. If you see, it's curved, then it's convex, and now we have another protocol, which it's called Vodium, and I'll switch over to that here. Let's see. Vodium. Okay. Yeah, you should have that up there.
Yep, there
so
it is.
So basically
Vodium.
what they do is, you can vote every 2 weeks on Convex, or you can delegate your voting power to Vodium. They'll do the calculations. They'll determine what's the most profitable bribes, and then you'll get the whatever formula they came up with of tokens that you should receive. So here's just some of mine in there, and I haven't. There's too small of amounts because I only think I did it 1 or 2 rounds, and I'm like, well, okay, I got $60 here, $70 there, and it goes down. There's probably 10 tokens. I have Alchemix tokens and Tribe tokens, and but they're so small. I can't even claim them, because the gas would, be 10 times more.
I have some old Tribe tokens that I'm too embarrassed to look at because of all that in the past.
Yeah, I understand. So I'm like, well, this is kind of great, but it's also it wasn't getting me anywhere, right? It's like I'll just go back to the old voting and just put 100% on for MIM tokens or whatever and see. I don't know if that's efficient, but that's a collateral. I would get all of my votes, so it would amount to something that I could actually claim and actually have some money left over at the end, right after I paid gas. And that's been months ago, and it was really expensive. So it was like, just let it ride. This is a great thing, delegating your voting. They optimize, they take like 2%, right? But, they optimize for the best combinations and do all the work for you. Obviously, you have to hope they're doing a good job and somebody's not bribing them, right? They probably are. I don't know. Hope nobody's listening from there. That's nothing personal. The next iteration, which I think is the coolest part, and I'll switch to it. It's called the Llama Air Force, and Curve is they're kind of they have a their meme is the llama, right? So let me see here. Let's try to switch this over. The Llama Air Force. There we are. And let me see here. Can you see that?
Convex Finance, DeFi,
Yes.
Maker.
And I'll go ahead and roll through this. So what this does is it hooks in with Vodium, and it basically says, okay, whatever Vodium says, we'll take all of your tokens, and there may be 10 of them, depending how the dispersion of the votes is, and it's optimal, right? And what we're going to do, we're going to take all of those, and since they have a lot of people that are interested in doing that, you can be paid out whatever you want in one transaction instead of converting 10 coins over one at a time and paying gas. So this is really efficient. And so that's what they do. Now, just to kind of summarize a little, kind of going back to Curve, and I talked about staking your CVX and getting that 42% that we saw in Convex. If you lock your CVX token and basically go with the bribes, it's paying about 43%. So it's about the same. And a while back, when I started seeing these bribes, I had most of my money over here in the staked CVX CRV side. Actually, everything was there. And I split my bag down the middle and started going for the bribes. And that was probably about a month or two ago. Thankfully, I did. But anyway, so that's how the APY or APR actually on this is done. But here's kind of some of the stats. There's $444 million worth of curve permanently locked in its contract. And it continues to seize at a rate of they're adding about 40 million curve every month. So they're just growing. Convex itself has 16 billion in TVL. That's not that far behind curve, and they control 55% of the voting power. So that's why they're called the DeFi Kingmaker, because they actually are the ones that they control curve through the voting. So they basically tell curve where to incentivize these gauges. I mean, they have that much power. So let's see. I don't know if there's anything else in here that's, but Convex itself, they do about $48 million a month in revenue, and $500 million annually from all of their activities, which I think is pretty decent. Let's see. Here's Vodium. Here's the union, which is. This is where they consolidate all of your tokens, and then you can withdraw it however you want to withdraw it. You can CVX, CRV, you can go ahead and relock your CVX. So when you claim your tokens from this protocol, then that's why they call it the flywheel. Then you just start all the way over at the beginning of the flywheel and dump it back in, and it just continues to produce. One cool thing that they do, these claims aren't just sitting here, right? This is accumulated, a week or two worth of rewards, it's $300. But they have these compounders, they call them pounders, and those are doing about 51% APY on your bribes, because they're reinvesting, they're doing the same thing, right? So it's kind of this whole ecosystem that has evolved. And let me go ahead and get back to the video part. This is a whole ecosystem that evolved from Curve, the OG, to some really bright guys at Convex and say, well, there's all these LP tokens out there. Why don't we farm them? Why don't we go ahead and control the voting power of Curve? Because it is a governance-run organization when it comes to directing which way their incentives go. And so they stepped in about a year ago, and then Vodium came in and added a whole layer, which is the bribe layer, and then in comes the Llama Air Force, and they're basically they're just capitally efficient, right? You don't have to cash out all, if you got hundreds of millions of dollars, and even the small tokens add up to a lot, that's fine. But for the average person, or even not the average person, I mean, it's just gas efficient, and because it's only one conversion at the end, and you get a pick between 3 or 4 different, tokens, all in the ecosystem, which again starts that.
So Llama Air Force is a good spot for somebody who's maybe a small-time farmer and they want just one step,
right,
and to not worry about gas.
Right. We don't want to have to claim CVX, and we don't want to have to claim an Alchemix token, and because there's decisions made. Is this a valuable token? I'll just hold on to it. No, let's just cash it out. Yeah. I mean, there's a lot in there, and people are looking at these solutions from DeFi. And the thing that I like about this is making it. Although I went through a lot of steps, and it is very complex, no doubt. This is not something easy to grasp, but those efforts to optimize and be gas efficient and allowing the retail investor to uh, basically be on par with the whales. I mean, you're not blowing all your returns on gas. Which, believe me, building my bag
It
up in
adds up.
Curve and Convex is all on Ethereum over the past year. I paid dearly in gas, and but
Yeah.
it's something I believed enough in, and it has evolved into something that I think is very meaningful. I think it's the direction of a lot of protocols will be going to this. I spoke about Frax. I can go into a whole nother presentation how they do it. So I've locked my tokens into the Frax protocol. I'm earning bribes there. I'm earning bribes here. And so that's my main focus right now. I've really pulled back from the degen side and go, this stuff actually makes money, and it makes good money. And a lot of it.
And pretty consistently.
And you know what the great thing about it is, and this is the thing that I've been talking about probably since September, is all this is based on stable coins. It's not other than something depegging, and don't go with risky stuff that gets, may get depegged, and but these are all stable coins, tried and true stable coins, and with deep liquidity. So it's not, you don't have to worry about what the rest of the market is doing. You do obviously somewhat, but there's some insurance there that, you're not gonna, oh, I've been collecting, this token over here as an incentive for the past 6 months, and I got a big bag, and all of a sudden the bottom falls out, and your 120% return that you were getting in that, farm or whatever is now, 10% because it's lost, 90% of its value. But that's not really what's going on here. It's based on stable coins, which, I'm a few years from retirement, and I keep reminding people, and I talk to the guys at Decent DAO about this, and they're wanting to know how to get older folks involved in crypto, and how do we get them into DeFi? And it's like, it's stable.
Start with stable coins.
It's stable coins. It's a stable return.
Yeah.
It's a better return than they can get in the traditional world. It's much less risky. But as you can see, the returns here can actually be pretty sizable. So take some homework, take some study. But I think it's a worthy path for somebody to take if they're not like myself. I'm not an NFT guy. I mean, I'm a boomer. It's not ever really going to resonate with me as it does younger people. And believe me, as you know, there's a ton of money there to be made. But like everything in DeFi, there are so many different things you can go down the rabbit hole, and then you'll just never go anywhere because you're just chasing rabbits, and you just need to stick with one rabbit hole and not chase a bunch of rabbits in other holes, and just
I would encourage
concentrate your time, your energy, your research in one area, and be good at it. Because if you're going to be diversified and a jack of all trades, no. Maybe some whales can pull that off because they have a little bit more to play with. But for the average guy, just whatever resonates with you, whatever you understand the most and strikes your fancy, go for it, get good at it, build some conviction, and do it.
That's so true. Build your niche, build your specialized knowledge, and don't get caught up in like chasing the new thing all the time.
Right.
Because as John just said here for our audience, like this is a new concept that really isn't new anymore.
Right.
Like these types of concepts have been around and they're tried and true within DeFi a couple of years, which is like light years for DeFi timeline. And if you think about the opportunity cost that's lost chasing the next NFT pump, if you're not particularly sophisticated or have a methodology for catching those returns, you're missing out on this stable and consistent return that was at 70% is maybe pulled down back to 40%. But still, if your money had been invested there for the past year and a half, instead of constantly getting lost on the next NFT that's dumping, you're in a position where you would have been better off.
Right.
Maybe just having
Right.
a
And,
passive approach that's specialized.
as with anything, there's no guarantee these I keep picking at it. It's like, so how is this gonna unwind? How is this gonna not work anymore? And what signs should I look out for that maybe it's time to pull back? But I haven't found that. I'm going to continue to look. I'm just going to be cautious. But I think that with the stablecoin approach, there's much less risk of getting rugged, so to speak. These are all tried and true protocol. Well, Convex and Curve are these other two, but they're really pass-throughs. They're really not, they're not really putting what you've earned at risk. Now they could steal it, obviously, but there's a lot of eyes on it and a lot of people invested in it that are top quality people. So I'm not too worried about that. But as with anything, there's risk, right? There's not financial advice, but this is how I've done it. So I just wanted to share what I've learned and what's possible out there without taking tremendous risk. And I just thought it was a good time for it. I think I don't.
Yeah, I agree, John. Thank you so much. Like, I learned a lot here, actually. I mean, I've always been familiar with Curve and Convex to a lesser extent, but this was, something that I think people need to really think about for if they're looking. I think I can kind of describe the investor profile. If you're looking for something tried and true with extremely deep liquidity, with some exciting incentives that are built into this governance bribing mechanism, you can find a way to do some pretty rewarding and consistent yields that aren't getting inflated away by a declining token price. Because, like John has mentioned, these are stablecoin yields. Obviously, sometimes there's Curve in there and other assets as well, but generally speaking, these are more stable.
Right, and and that's why I guess it's been probably 6 months. They've dubbed this the Curve Wars, because all these protocols that own their own liquidity, that basically own the liquidity pool on Curve, or a large portion of it, is the way that they want to lock as many Curve tokens like Convex did. They're all wanting the same piece of the pie. So that just kind of perpetuates, and it is a bit of a gamification between these protocols, because it's like, because you'll see, because they have I think the voting period is like a week long, and they'll start posting bribes, and it's like, do you post early and then somebody one-ups you? Do you wait till the last minute and bribe, and then the number goes way up? It's actually fun to watch.
Yeah, it's like poker or game theory. It's very, you got to base your move based on what someone else is doing.
Right. So, like over on Frax, with the FXS, the voting lock token, and their gauges over there, there's only a couple protocols that have started, but it's gonna start going more. But Temple was one of them, and I've been, I collected a few of those myself the past couple of weeks.
Yeah.
So it's something. It's interesting, Even if the bribes never came around, I was sitting there with CRV CVX making 70 or down to 40% now, and it's like, if it never would have gotten to bribes, I would have been perfectly okay. But this is just a little flavor on top, and it's competition between protocols, which is also always healthy, so it's all good.
It's all good. So, John, if somebody wanted to take just the first step of getting on this, you would recommend going to Llama Air Force.
Mm-hmm.
And what would be their first step?
Well, that's basically where you would end. You would want to start on the Convex platform and kind of devise a strategy. Do you have an interest in getting a boosted yield off of a liquidity pool that you might have, or a liquidity pool token off of Curve? It all originates in Curve and flows through. So I would say get familiar with Curve, understand what they're doing there, and it all proceeds from there. Now, I took a shortcut and started at Convex and just bought their token and started going. And you can do that. You can literally probably the quickest shortcut is just to buy CVX tokens and lock them in the Convex platform and start voting and start earning money, and a decent return on top of that. So yeah, it's that's the shortcut. Yeah, but I really did want to take it all the way from the beginning through the end, so people knew. This wasn't a 5-minute alpha, BitBoy, buy CVX token, bribe. No, I wanted to give you some background in why this ecosystem actually works and why it's probably going to be around a long time. So,
and that's what we try to do here, John, is we want to maybe understand a little bit more at a fundamental level what actually is going on, because this isn't just a simple, like, here, try to make a quick 40x and you don't know how or why.
Right.
If you understand why these things are happening under the hood, you can make a little bit more of an informed decision. So I hope this is helpful for our audience. If you have questions about this, of course, we'd encourage you to join our Discord group and ask the man himself, Farmer John, our yield farmer, who's absolutely crushing it in the yield farming stablecoin space. So definitely encourage everyone to check that out. We'll post links to all of these in our description of this. John, is there anything else you want to add?
I think that's about it. It went well. All
right, everybody. We'll see you in the next episode. Thanks, John, for all your help on this and for educating.